Hi, welcome to the Seattle Angel Conference workshops. We do these as a way of building the connections between people on the way to doing our angel training program that we're starting. So Seattle Angel Conference 29 is starting next week. And we gather a bunch of new angel investors to make them learn enough about angel investing to write their first check and then hopefully go on to do things like run angel groups or start funds or otherwise be proactive angel investors. Today we have Amit Singh, who has been working on this notion of a series safe, which is sort of the next iteration of the safe process, which is different than a convertible note. And so, given our current audience, we probably should build a little bit of context before we dive into the talk, if that makes sense, Amit. So, Amit, you want to give a brief overview of who you are and how you got to the point where you were doing things with safes, and then we'll talk about convertible notes and safes and how all of that stuff might be different.
Yeah, absolutely. So, John, thank you for the invite and hello, everybody. I appreciate you allowing me to spend time with you today. So, I'm a partner at a law firm called Mintz Levin. Mintz Levin is about 650 lawyers focused on all the innovation centers of the country. We're a full service law firm. We have all the IP, prosecution, and litigation folks, general litigation, and we have a very strong corporate group, for example. And I'm a corporate lawyer. I focus primarily on I'm what's called an ECVC and M&A lawyer. So that means emerging companies. So I assist companies from formation all the way through their rounds of financing through an exit event. I represent investors, venture funds, uh, sovereign wealth funds, et cetera, investing in those types of companies. I represent private equity funds acquiring those companies, and I represent the companies when they eventually sell. And I've done about 650 venture financings to date and about 200 M&A deals in the last 27 years. So I've been pretty focused on this. And in the beginning, we didn't have safes, and it really changed the landscape quite a bit because now about 90% of all non-priced rounds are on safes, and the other 10% are still convertible notes. And why is that? It's the you originally the point of these types of instruments is to delay the argument about what's the valuation of the company. So maybe we just don't know early on, and we don't want to be investing at some high valuation and end up having to adjust our conversion rate, et cetera, because the next round is at a lower price. And the founders don't want it to be at too low a price and feel like they gave up too much equity. So we just agree that we'll just agree on a cap. The next round might be at a lower price, but this is the most we'd be willing to invest at. And uh, and the advantage of these types of instruments, and it used to be a pre-money valuation. So if I invest $1 million in a $10 million pre-money safe or a pre-money convertible note, then every dollar that's added dilutes not only me but also the founders. Now the market has changed, so it's a post-money valuation. So if I invest $1 million at a $10 million post-money valuation, whether it's a convertible note, a safe preferred stock, I will represent 10% of the cap table before the next round occurs. It doesn't matter how much additional capital is raised. So every dollar that's added, I'm still going to be 10% of the pre-conversion cap table. And that's very attractive to me as an investor because I know that I don't have to worry about what the other people are doing, raising money, et cetera. But founders have to be very careful because it's a zero-sum game. Every dollar I raise only dilutes me and my co-founders. The investors aren't being diluted. But that's just the way the market is now, and we have to live with it. Sometimes when I'm company side, I'm able to get pre-money safes, but for the most part, this is the environment we're in.
So I want to sort of bring it down to ground a little bit. So the person that is deciding what the terms of the investment are, it turns out in the end is really the founder. And the problem is that most of the founders don't know what the choices are, don't know what the market is. And so a lot of times they get advice from their lawyers to do the normal thing. And the normal thing might not be appropriate for who they are and what they're doing. And they can't help themselves make the decision because they just don't understand what the choices are. So let's go through those choices a little bit, right? So in the beginning, you would sell common stock, right? I have 10 million shares and I'm going to sell so many shares for so many dollars and that's it. And it's a little tiny subscription thing, five shares for $50 or whatever the choice was, and away we go. And then we got to the point where everything was wanting to have some kind of specialness. And so we ended up with preferred shares, which is a different class of stock, right? And so I have common shares, which typically the founders are common shares. And then I have preferred shares that have extra rights that are baked in. Typically, we're looking at rights like um, a liquidation preference. We're looking for veto rights on certain kinds of decision making. We're looking for information rights that might be different. We might ask for a pro rata, or we might ask for a most favored nations clause. Those are the ones that come to my mind at the moment. We bind those into the preferred shares, which eventually those preferred shares basically control the process until it gets sold and then they get converted to common stock and divvied out, right?
Yeah,
And
well,
the
they have
prop
negative control. If they don't have majority, they don't have active control, but they can stop certain things from occurring. That's right.
Right. And then we got to the point where I want those specialty things, but the negotiation of the details of that was complex enough that we started using this bridge note methodology and pulled it down and called it a convertible note, where I'll give you a loan with interest and we make it look like a loan. And then that loan then converts to stock when we actually preferred stock when we actually know something about the company enough to make a price. And we let the professionals at the next round do it. So one of the things the founders need to truly understand is that by picking a convertible note or picking a safe for that matter, you are committing to having a follow-on round that's a qualified round of a certain size from professional investors of some kind. And um, you're forcing yourself to another round, right? It's not a one and done kind of investment, which it could be if you were just selling common shares. You could do, I just sell the shares once and then that's it, right? So it puts you on a
Well,
very
I
specific
guess, John,
path.
I wouldn't, it's possible you don't ever do another round, right? And that's the worry for investors. They invest in a safe and the company never does another round, and I'm just a safe holder forever. What does that
Right.
mean for me and my rights?
Right. And so we try to stuff in uh, like Hall Martin has his 3 by 3 mechanism for converting to a revenue-based payout after 3 years, or we've tried to put into our clauses a revenue-based exit after a certain, decision point has been made. But we always have the lawyers on the other side fight with us about that and rip that right out. But as investors, we don't really want what we call a zombie company where it's living for 20 years and there's no dividends and there's no mechanism by which anything happens. We basically become a donor to the founder for his lifestyle, which, I got enough family members that I would rather do that with. So, in terms of the crafting of this, there's some sharp edges along the way, right? And so, we've been evolving that over time. Um, we have now this notion of um, a note that was pre-money, that then it was a note that was pre-money with a cap, then was a note which was a post-money, and then a post-money with a cap. And now we're adding another thing because we have this thing called QSBS. So we should sort of define what QSBS is, which is it's basically Rule 1202, which basically says under certain circumstances, you invest in the stock of a company and you hold it for 5 years, and the company is less than $50 million, then the first 15 million, I think is the current number of capital gains is tax-free, right?
Yeah, it was, I guess there's a couple nuances. So the uh, Beautiful Bill Act or whatever it's called increased it from 50 a company with gross assets of 50 million to 75 million. So you're investing in a domestic Delaware C corporation that has aggregate gross assets of $75 million or less, that is involved in an active business. So it's got to be a qualified trade or business, which excludes law firms, accounting firms, et cetera. And the company can't have had significant redemptions of its stock. And if you meet those requirements, you can exclude the greater of $15 million or 10 times your basis in the stock. So if you invested $2 million, you can exclude $20 million from federal income tax. And that's if you hold the stock 5 years. It used to be that that was the only, it was such a cliff. At 5 years, anything short of 5 years, you get no benefit. Now it's been adjusted. So if you hold it 3 years, it's a 50% exclusion, 4 years, 75%, and 5 years, still 100%.
Right. So in that box, one of the issues is when we have an exit, like we just had an exit for Seattle Angel Conference number 5. And just to help people understand, in 2014, we invested in a company, and in 2025, we exited a company. So angel investing is a long duration activity. But nonetheless, we need to be able to set the clock. When did it get to be stock? And do we consider a convertible note stock? Well, no, it's explicitly structured as a loan, so it doesn't start the clock as far as most people are concerned. There's a lot of language being slapped into convertible notes that's trying to pretend that it's stock, and then you're trying to do something that says this is definitively stock. And so there's a question about when the clock starts, and then we have to keep track of that and make sure it's at least 5 years. And it matters because 100% tax-free is a good number when you've got a 25% tax rate, right? So are there any questions about what a safe is or what a convertible note is, what a preferred round is that people want to bring up now before we dive into the meat of the question?
Well, how about before we do that, why don't I explain the
Okay,
difference between the safe and the convertible note? So
right.
as John mentioned, a convertible note is a loan to the company with an interest rate and a maturity date. So at some point, that loan becomes due. However, if before the maturity date, the company raises additional capital, that loan will convert into preferred stock at the next round at either a discount or a cap, or maybe both. And the benefit is that you get some interest rate, but frankly, if you're investing in these high risk investments for 8, 10%, 12%, you're just in the wrong business. You're taking on too much risk for that. And then you get this, let's say it's 2 years from now, the instrument matures, and then you get some leverage over the company. You could theoretically foreclose on the note and maybe take over the company, but that's not practical. And then, or
But
you
it
just
but it might actually be kind, just to be clear. As an angel investor, it might be worth our while to grab the short hairs of the company, foreclose on the note, and kill the company so that that founder can go do something productive later instead of spending 5 years or 10 years playing with this toy that's never going to get anywhere. And we have some companies in SAC that are still alive, probably ought not be alive because it's just the stubbornness of the founder that keeps it a running company, not any productivity out of the company. Sorry,
yeah.
commentary.
Yeah, no, absolutely. But you theoretically could take over the company, but that's often not very practical because maybe you don't have the skill set to run that company or the interest in running a company. And and then also what you does give you generally is leverage over the founders to say, hey, look at we'll foreclose on the note unless you do this or that we request. And so that gives you some leverage. But what you're giving up is, as John mentioned, you're clearly giving up the ability for it to be qualified small business stock until the date of the conversion. And in my mind, the downside is much less important to protect against because these are generally binary investments. Either you're going to make a lot of money or you're going to lose 100%. So being able to get at the assets in these companies, really, you generally have no assets. You're not going to get anything out of it. But giving up that tax benefit on the upside, I think is too much to give up. And so that's why the one reason why the safes exist. And so a safe is exactly the same as a convertible note, but you take away the interest rate. Like I said, I don't think that interest rate is very valuable. And you take away the maturity date. So it's just a contract that at some point this is going to convert into equity and at some certain rate. And it's got a post-money valuation cap. So again, if I invest $1 million in a $10 million post-money safe, I'm going to represent 10% of the company before the new money comes in. The new money is going to dilute me and everybody else, but I'm going to be 10%, and I know that. And there is a good argument that that is stock at issuance and not conversion. I make that argument all the time. And but ultimately it's unclear. And so
Nobody's pressed the question to an answer, right?
right, that's right. Yeah, the IRS has never said no, and the IRS has never said yes. And so we spend a lot of time spinning our wheels talking about it. And that's why I decided to solve the issue. And I created this series Safe Preferred Stock. And
So before we dive into your presentation, which I'm looking forward to, I want to bring up the notion, why do we do this instead of some other kind of thing? Why don't I just go on the cap table as a priced round, right? So one of the things that I teach in the Angel Conference is that people should be writing many small checks. And in my math, so anybody who's below 5 million in net worth probably should be writing many $5,000 checks, not writing a handful of $50,000 checks. And so when I do that, I end up getting pushed away from being on the cap table because we don't want to have too many people on the cap table. So can we talk a little bit about why wouldn't I care about the number of people on the cap table?
why wouldn't you, or why would
I,
you
I
care?
mean, why is that important? Why can't I just, take everybody, take the next 1,000 people that are willing to give me $1,000 and put them on my cap table?
Well, at some point, if you reach a certain number of shareholders or equity holders, you're a public company and you've got to comply with the public company requirements.
But that's like
But
2,500, so
yeah, so
that's
it's a very
still
large,
that's
yeah, it's a very
far,
large
far
number.
away.
But then also, you don't want to have to deal with a large group of people if you need a consent to do something. You don't want to have a bunch of people fly fishing and you can't reach them, or maybe they're just unreasonable. And so that's why typically we're going to have a large number of investors. We put them in a special purpose vehicle, an LLC typically, that has somebody we think is reasonable at the helm and makes all the decisions for all those investors. And it's a one line on the cap table.
Right.
And it's very important to the venture, the more sophisticated investors who come in later, because they don't want to deal with these small holders. They want to know that if we need to get something done, we're going to have somebody reasonable to deal with and not have all these minority holders to deal with. Or if we're selling the company, try to figure out how many stock certificates to issue. That's all handled through this vehicle that appears as one line on that cap table.
So when you say that like a lawyer, and I'm using that word derisively right now, because
People often do.
that's yes, TML. So that's a default answer. Put it into an LLC, which causes all sorts of ripples and troubles, which I will do more workshops on why SPVs suck later. But to mention that K1s are one of the problems, and there's a whole bunch of issues. But the core issues that I want to make sure we name are I'm making a decision. I need signatory consent on something, and I need information rights. And so keeping and managing the information rights and managing the decisions. So one of the options I want to put on the table is the notion of having a different class of stock for people who have no decision making and have bounded information rights. And so it solves the problem of venture capital needing to have to deal with the people when they're making decisions along the way.
Well, I guess,
As
John, what I would say is even if
one,
you had people who are non-voting, they had non-voting securities, there are still certain fiduciary duties that are owed to them, and there are
Mhm.
certain events in which they would get a vote,
Right. No,
nonetheless.
I'm clear. I just want to put a stake in the ground on one end that we could have classes of stock that operate one way as a priced round, and we can have the traditional SPV process where we gather people together and hide people from it and give one person the ability to talk. And then we have the safe, which is now on the other side, and you're like in between those, making stocks but not making stocks, right? And so let's dive in.
Okay, sounds good. Let me share my screen here. There we go. So the series safe preferred stock is it provides you the safe-like economics, but you get actual stock. It's a new investment vehicle that combines the simplicity of a safe with clear, qualified small business stock tax benefits and stockholder protections from day one. So, like we talked about, safes are incredibly popular. They're very simple, and they may be stock for qualified small business stock purposes, but as we've been talking about, that status is unclear. In addition, safe holders are contract parties. You have a contract to get stock in the future or get treated a certain way if the company gets sold before that occurs. But Delaware law provides all stockholders certain fiduciary duties. The board and management owe the duty of care and the duty of loyalty to stockholders. So they can't just decide, hey, there's this company I want to acquire. I own it, but I'm going to pay some exorbitant price for it and have the company buy it, even though I'm conflicted. Or we're going to increase our salaries to some crazy level. Uh, if you're a stockholder in the company, you've got some ability to block those actions because they owe you fiduciary duties. Versus a safe holder, you typically don't have those rights, or you may not have those protections. There's the baked in uh, good faith and fair dealing obligations that both parties have to any contract, but those are tough to rely on, very vague. Delaware corporate law has many years of litigation, clear statutory protections, etc. So it's easier to rely on when you're an actual stockholder. And that's what this Series Safe preferred stock provides. You are an actual stockholder from day one. And and often when I represent an investor, we don't just give the simple safe. We have a side letter that says we're going to get information rights. We're going to have certain protections. You're not going to do these various things without our consent. Uh, we're going to get maybe a board observer, things like that. But uh, but again, without something like that, you don't have any right to information. A lot of times people invest in these safes and then they don't get any information from the company and they have no right to get information from the company before they convert to stock. And so, but through my structure, you're an actual stockholder. So under Delaware 220, you get information rights. You get to see, you can get information to value your stock, get to see the charter, the investment docs, minutes, things like that and uh, and also you have if there's these are non-voting, much like a safe. The goal was to make it as close as possible to a safe. So like a safe, there's no vote generally, but under Delaware law, there are certain situations like where the Series Safe preferred holders are being treated differently than other classes of stock. In that case, under law, they would automatically get a vote. And safes don't really have that protection. Uh, and we already talked about the benefits of being a stockholder early on and holding that stock, and you get these great tax benefits. So I won't double down on that. And we also talked about the QSBS requirements. So I won't and also so but what are the arguments that a safe is stock? So it's intended to convert into equity and is designed to function economically like stock. Y Combinator's, the creators of this, and practitioners, including myself, argue that they are safes. And in fact, the safe documents were amended years ago to say that everybody's going to treat it as stock. We all agree it's stock. Uh, and, and we treat it that way. But the IRS has not said, yes, it is stock. And then what are the arguments? Sorry, it has not said it's not stock. And then what are the arguments that it's not stock? Well, it's not issued under the charter. Stock is always issued under the charter. You authorize X number of shares and you issue those shares and get a stock certificate for those shares under the certificate of incorporation. A SAFE is just a contract to get stock in the future, but you don't really have that. And Section 1202, the provision that creates QSBS, this tax benefit, requires stock issued by the corporation. Again, a SAFE may not meet this definition until it converts into actual shares. And the IRS could be very strict in its analysis, just say there's no stock certificate, there's no stockholder rights, there's no fiduciary duties, it's not stock. And the IRS has not said that it is stock. So you do run that risk. But what is the Series Safe Preferred? So Series Safe Preferred, and it's accessible on seriessafe.com by anybody. You don't have to use me for this, although you should talk to a lawyer before issuing anything in your company. But it doesn't have to be me. But it's stock from day one. Each investor is buying one share of Series Safe Preferred stocks. You don't have to do a bunch of calculations to figure out what's the per share price or anything like that. You just get one Series Safe Preferred share and buy a three-page stock purchase agreement, and you become a stockholder immediately. And it's safe like economics. So both safes, so a Series Safe Preferred share converts in the next round at a price that provides you more shares, whether it's the price that investors are paying in the new round or the post-money valuation cap divided by the cap table of the company before that conversion occurs. So again, if I invest $1 million at a $10 million post-money safe, I'm going to represent at least 10% of the cap table in the next round. And that's true whether it's a safe or Series Safe preferred stock. And again, you get the Delaware law protections baked in, and it's clearly stock from day one. And so how does it work? So there's a simple charter amendment, and it can be modified if you've never had a charter to use it from the beginning, but try to make it as easy as possible. It's only a few pages that you amend the charter that creates the Series Safe preferred stock and defines the conversion rights, the rights to dividends. So there's dividends paid on common stock. You get that as well. And your priority on liquidation. The series, like any other preferred stock, the Series Safe preferred stock gets paid before the common. And and then the investor, like I mentioned, purchases one share of Series Safe preferred stock pursuant to stock purchase agreement. And that purchase agreement has the investment amount, how much you're paying, and the agreed post-money valuation cap. So you can authorize 300 shares of Series Safe preferred stock, but then issue, let's say, 10 at a post-money valuation of 5 million, and then 10 at a $20 million post-money valuation, et cetera, the same as you can with safes. And so you don't have to amend the charter every time you're doing a new round of these safes. I would caution, I wouldn't be stacking these things too much. And founders need to be very, as John mentioned before, need to be very careful that they understand what they're giving up. And so you should have this all modeled out before you're issuing anything, whether it's safe, Series Safe preferred stock, or stock for that matter. And again, you're a stockholder immediately, get those fiduciary duty protections, inspection rights, and your QSBS clock starts immediately. And it's non-voting generally from day to day. You get pro rata dividends if those are paid, and you get a class vote protection against adverse treatment differently than other classes. When the next round occurs, it automatically converts to preferred stock at the lower of the price paid in the next round or the post-money valuation cap divided by the cap table of the company. So I get that 10% guaranteed at least before the new money comes in. Exactly the same as the safe. And I think it was Chris that asked this question, and it was a very good question. What happens if you have existing safes outstanding? Then could you just convert them into this? And what you really need to do is you need to review all your outstanding convertible instruments to make sure there's no unintended consequences by issuing this. So when you issue a safe, you file that charter amendment and you sell preferred stock. The standard Y Combinator safe says that if you issue and if you do an equity financing of preferred stock, it doesn't have a minimum raise typically. So when you issue these series safe, those safes, all things being equal, if you don't do anything, would automatically convert into this. And that is, you have to make sure you model out what the effect could be. So, for example, there is a safe form that just provides a discount. So, if you have a safe that says a 20% discount to the next round, that could arguably apply to the issuance of these Series A preferred, so they could get a 20% discount to these shares, and then on top of that, the cap could apply in the next round, so they could end up with more shares than are intended. So what you should do is, if you have something like that outstanding, model it out, talk to your lawyer to make sure you understand what could happen. And if there is a situation like this, like you have a discount baked in, you should have those documents amended to convert at whatever you agree the result should be. You shouldn't just uh, have it, because it wouldn't make sense for you be stacking these discounts. And then a lot of times investors have these side letters that have most favored nations clauses, which say, if you give somebody else better terms, I get those terms. And make sure you review those provisions to understand what the effect of issuing these or safes or any other security could be. So before you issue any securities, whether including Series A preferred, talk to a lawyer. Doesn't have to be me. Review all your outstanding safes, notes, warrants, or side letters to identify any provisions that could be triggered by issuing these securities.
I
So
don't
there we go.
think you answered Chris's question as directly as it needs to be for him to understand. So if I have issued a previous round of, like a post money safe here and a pre-money safe there, and I want to sort of clean them up, what actions do I have to do to make that work?
Yeah, so without doing anything, when you issue these, those would automatically convert into Series A preferred stock. That
Because
may or
the
may not be the result you want, depending on
because
what the
be-
effect would be.
because this so in my understanding he would have to go back to the note holders and get them to agree to change it, or this acts as a qualified round and then drives the conversion because it's a qualified round.
That's right. If it meets the definition of qualified round, like if you just had the standard Y Combinator safe would convert automatically because there's no provision that says it has to be a minimum raise or something like that. Although whenever I represent investors, I always have at least a side letter that says you can't convert us unless you raise at least twice the amount of money that we're investing. You
Right.
wouldn't want to invest $1 million and have somebody invest $10,000 and have $10,000 dictate your terms. And so, but it is possible that this would automatically convert. So you want to agree with those investors, typically it's a majority consent, that we're going to convert, and there's a benefit to you because now you're going to have clarity that this is stock. Whether you had a note before, which clearly wasn't stock, or a safe, now we're providing you that clarity. In exchange, let's just agree what the effect of that is going forward.
And now everybody is on the cap table and it's measurable what everybody is. And I don't have to keep like shadow shares of this and that. And I don't have to do this pre-calculation of what the safes are over on another piece of paper, right? So it
Well,
simplifies for the founder the management of the investors in some way.
Well, I guess I would say that it is stock on the cap table, but it's shown as one share. So that doesn't, so it's really the conversion rate of that share based on the post-money valuation cap that would represent that 10% that if you invest $1 million at a $10 million post-money valuation safe, you still have to have those calculations in your cap table, much like you would with a safe, except it's actual stock. But you still need to track what that conversion rate is ultimately.
Well, a lot of times the founders that we get coming into our program have one spreadsheet that shows the shares, and have another pile of random stuff, which represents the safes, which then have no calculations with them. They're
Right,
just a pile of agreements, right? So that's a bad effect of safes, is that
right.
people don't do their homework on the safes and calculate the consequence of that process. Does this then help reduce um, the burden of keeping track of the safes in a way that allows them to um, not get surprised by what they've sold?
Frankly, no. If you would be confused by safes, I think you'd be confused by this in the same manner. Any cap table is not useful if it isn't on what we call a fully uh, converted basis, a fully diluted basis. If so, you have to have a cap table that shows what is my ownership percentage if everybody were to convert and every option were to exercise and the entire option pool were issued, what is my percentage? And that is true whether you have a convertible notes outstanding, whether you have preferred stock, whether you have safes, safe preferred, regardless, you need that proper cap table. That's the only valuable cap table. What you're describing is definitely not useful, and I've seen it many times that you have this list of safes we've issued, but it doesn't relate to the existing shares that are outstanding. So you don't know what you're getting or what you own.
Right. And so you would call this a fully diluted cap table?
That's right.
And most of the founders that put things into their deal rooms for us do not have fully
Hmm.
diluted things. That's one of the things we end up asking for, and many times don't get calculated out by the time we're done with the finals. So founders should get that as an instruction when they're putting things together in their round. They should be explicitly doing a fully diluted cap table before they issue a round. Yes?
Absolutely. And that's the benefit of not only the investors, but also the founders. If I'm an investor and if I invest $1 million at a post-money valuation cap safe or safe preferred stock, I know what I'm getting. But I still care what the founders have because I want to make sure that they're properly incentivized, they're properly rewarded if the company does well. And of course, when I'm a founder, I want that to be true. I want to understand. And so if I'm investing in a company and these guys have issued safes that make it so they own 10% of the company and they're going to get diluted in several rounds after that, I know I'm going to need to uh, give them more equity at some point and dilute myself or bring somebody else in when these guys decide to leave and stop running this because they realize they're totally disenfranchised and dilute myself then. So it is important for everybody to understand the situation for both ends.
Right. Absolutely. Now, the process you're proposing includes a cap, right?
That's right. So
And
it has a post-money valuation cap exactly the same as a safe.
right. And so then we've been getting a number of uncapped safes recently. And so can you talk a little bit about the importance of a cap?
Absolutely. So you do sometimes have, let's say, a safe that's a 20% discount to the next round. So if I invest at now and the next round is at $10 million, I get treated as if I invested in an $8 million pre-money valuation. That may be totally fair. That's probably reasonable. But with the worry is you invest in these high risk businesses, you take on massive risk, somebody else invests a year later, and let's say the company arguably was worth $10 million when I invested, and now it's some AI company and it's $400 million in the next round. A 20% discount is little solace to me for missing out on that huge upswing. I'm not properly compensated for the additional risk I took on by coming in early. And that's why we agree to the cap. And so no matter what, maybe we agree that if the company's arguably worth $8 million today, we say, well, make it a $10 million cap just to split the difference. And but I do not want to be in a situation where I gave you capital, you use that to increase the valuation 40 times what it is today, and I'm not properly rewarded for it because a 20% discount, even a 50% discount, would be little solace for that. I'm not properly compensated.
Absolutely.
Okay. So again, Yeah, I'm probably beating a dead horse if I go through this slide. So I'm not going to talk about this comparison anymore because we've gone through all these issues. But this, I'm not going to go through these calculations, but this is just to show that economically, it doesn't matter if the next round is above or below the cap, the economics are going to be the same whether I'm getting shares or where I'm getting a safe. Uh, it doesn't matter. The economics are going to be exactly the same. After the next round closes, doesn't matter if I invested in a Series Safe Preferred or a safe, my outcome is the same in the next round. And also if the company were to be sold before the next round as well. So what I would say is generally this is all investor favorable. So this favors the investor over a safe because you have those fiduciary duties. But ultimately, if I'm a founder, I want to reward my investors as much as possible. And I'm giving up a little bit more because of the fiduciary duties, but I am benefiting my investors greatly by playing with house money. I'm playing with the government's tax money by providing clarity to my investors that they are getting stock, providing them that comfort. And that alone is valuable because entrepreneurship is a career, and you shouldn't look at your first capital raise and that first business you're starting as the only business you'll ever be involved in. Typically, these founders are serial founders if they're successful. And so you'll found this business, provide a good exit, hopefully provide a tax uh, efficient exit for your investors. And the next round, you'll be able to get a larger percentage of the cap table and have those investors invest with you again. And so and you'll be able to attract more sophisticated investors. I do represent some VCs that just hate safes. They will invest in them, but they hate them, and they've loved this new structure. And so, and
So
angels too.
is it true that the founders also get QSBS?
Well, the founders generally get QSBS unrelated to this, but because they are getting shares in the company before it has $75 million in gross assets, their shares are typically qualified small business stock from the outset. Somebody did mention a question about, or they had an LLC and they're going to convert to a corporation. That actually has some benefits, but you just have to be cautious the way you do that. If if you do it wrong, because there has to be stock originally issued by a corporation. So you want to make sure that you're effectively exchanging your LLC interests for new stock in the company. And otherwise, it may not be an original issuance by the company, and you may not get qualified small business stock in the first place. And
So say that again in a shorter sentence so that people understand that this is really important.
yeah, so when you convert from an LLC to a corporation, the stock issued by the corporation is only qualified small business stock if it's issued by the corporation to you directly. So if it is issued, for example, to the LLC and the LLC liquidated and you got your shares that way, that would not count. And so you need to be very careful the way you structure it. But there are some benefits to start with an LLC. We talked about that the cap is 10 times your investment, so or 15 times your investment. So if I'm a founder, pay me a share, it's it's basically the $10 million cap is going to apply. The 15x is not going to apply. It's going to be $10 million. So it's the greater of $10 million or 15 times my investment. So my investment effectively is zero. So my cap is 10 million. If I start the company as an LLC and I grow the value to, let's say, $10 million, now it's 10 times $10 million because I've contributed $10 million in value for my shares. So my basis on that is $10 million now. And so it's 10 times $10 million, so $100 million instead of $10 million is my cap. I'm missing out on that first 10 million in gain. That's gonna be capital gains. But anything above that, the 10 to $100 million, that 90 million is going to be all QSBS. So that's a very big benefit to me. And so, but you're really betting on yourself that you're going to have a huge exit.
But
Uh,
had they started with the a C corp at the very beginning, then the capital gains on that first 10 million would have been deferred, but their cap on the deference would have been fixed at 10 million.
Well, they pay zero federal income tax on that first 10 million, if they found it if they started as a C corporation. If they started as an LLC, that first $10 million in gain will be capital gains, but the 10 million to 90 to $100 million is now going to be QSBS. So that's going to be zero federal income tax on that.
Yep.
That's a very
Excellent.
big benefit.
Yep. Especially if you get to be a $10 billion company. Yep.
Yeah, absolutely. And so again, you're attracting sophisticated investors. It reduces the need for side letters. It doesn't eliminate them, but it does reduce the need. Some investors may say, I'm okay and don't need a side letter then. Uh,
So Kevin is asking in the chat if the conversion to a C corp triggers the capital gains.
no, but if you're done properly, that should not be a tax event. But again, you should not do any of this stuff without a lawyer. These are very important issues if you're because eventually you're trying to protect yourself on the upside as much as possible.
Yep.
And then so the conversion math is exactly the same as safes. So the investors will understand this. There's generally no blocking rights. It's not like uh, Series A preferred on the NVCA documents that has all these protective provisions. Again, there are certain legal protections that the investors get if they're treated differently than other stock, but otherwise, there's no blocking rights by these investors. And the documents are very simple. You've just got a simple stock purchase agreement and an amendment to your charter that you can access at seriesafe.com.
John, can I ask a question on the cap?
Sure.
It's Matt. So Amit, thanks for sharing. So can you explain, because our safe has a cap and a discount. And the way it was explained to me, so our cap is $8 million. And so the way it was explained to me is that if the company is valued at 20 million, then the discount comes into play and the safe would convert at 16 million and the cap is irrelevant.
No, that would be exactly wrong. So
It's
if the company,
exactly the opposite. Yeah.
right, exactly. So let's make the example more extreme. If the next round is at 100 million, they're going to convert at 8 million. If the valuation is 8 million, they're going to convert at a $1.6 million discount to that 8 million. It'll be
Okay.
what, 6.6 million.
Okay. So with a cap, no matter the only the maximum that the safe holders will convert at is the cap.
That's right.
Okay.
So
Yeah.
the
That's
discount provides them a benefit that if the next round is at lower than the cap, then
they
they're
get a
they're still
discount for it.
getting
Yeah.
and the argument for that is we didn't know what the valuation was. Turned out that the cap is the valuation at the conversion date. But if it was the valuation of the conversion date, I still took on more risk coming in earlier. And so that's
Yeah.
why I should get the discount. That I will say that's not the way that's typically done. The standard Y Combinator off the shelf safe is just either you get the discount or you get the cap. If I was going to choose between the two, I would take the cap because I'm betting if I'm investing early that this thing is going to be huge and hopefully we get a reasonable cap.
So I mean, I'll have to read our safe because are you familiar with Morris and Forrester?
Yeah, good
Yeah,
firm.
so they're the firm we used, and I think they know what they're doing. I'll have to read it, but generally speaking, if it's a boilerplate safe, it's going to be what you said. It's going to be it's going to be either 20% off of something over 10 million, or if it's it's $8 million cap, or if it's below that, it's 20% off.
But if it was off
Um,
the shelf safe, it would be one or the other. So they have two different versions now. You have the discount safe, and then you have the cap safe, the post-money valuation cap safe. But it doesn't mean that it's not possible that the investors requested both and they modified the form to add the discount to the post-money valuation safe. So, these
Yeah, we
things change all the
we have
time. Like
both.
it can be
It's
edited.
both. So I'll have to read
Yeah.
it. I'll have to read it carefully. And then John, if you don't mind, could I ask one more quick question? No, it might not be quick, but one more question.
Um, Try to
Is that
make it
okay?
a quick question.
Well, so I've been told that you can negotiate any terms with any investor. So let's say you wanted to invest in us, but you're like, yeah, it's a little too expensive. So I can go to you and I say, okay, look, I'll give you a 30% discount on your shares. So you're going to get more shares for the same investment that you know Sandra Johnson did. And so that seems sketchy to me, and it seems hard to manage. And then if Sandra finds out, she's going to be agitated.
Yes. So the
This this is this is why we ask for a most favored nation status or clause in our agreements for Seattle Angel Conference is precisely that, right?
yeah, absolutely. And so let's assume there's no MFN provision in there. Then it depends on when this occurs. So if say Sandra and I are investing at the same time, I'm getting a 30% discount and she's investing at more, she's paying more for the same thing than I am, it becomes a disclosure issue. So you have some potential liability if you don't disclose the difference, because when you sell securities, and these are securities, there's a rule called 10b-5 that applies. So there's liability if there's a material misstatement or omission in this connection with the sale of a security. And so and that means that you have to, would a reasonable investor want to know that information when making their investment decision? And most people would say yes. Uh, but if it occurred, but if Sandra invested first and then I invest later and I'm able to negotiate a better deal or I'm strategic or whatever, and she doesn't have a contractual MFN or anything like that, unless it was just a safe, then there's nothing that she doesn't have the ability to prevent you from doing that, and you don't have that disclosure issue. So that's something she should have negotiated ahead of time. That being said, I would still discourage it. Yeah, but sometimes you have to do what you have to do, right? It may be that the business didn't perform as it was expected, and so we make the cap lower. And it may be that ultimately we both convert at the same rate because then the round is at or below my cap. Uh, but or maybe sometimes what we do is we say, okay, we sort of got it wrong. We're going to amend the existing investors' securities to give them the same benefit as well. It can go many different ways.
Thank you.
Sure.
Do you have more on it?
Let's see. Yeah, so, like I said, that's basically it. So, and I'm happy to share the link, but it's just at the bottom, seriessafe.com.
Yeah, I put it into the chat. Do you have
Okay,
a
great.
slide that has your contact information so people can find
Oh,
you?
yes. Yeah, here we go. My
Yeah,
email address is right there. And happy to
good.
chat, happy to give a 20-minute you know, free consult to anybody on this call.
Cool. Thank you. How about if you stop sharing your screen and we
Yes.
take a look at everybody and see if anybody has any questions. So, any thoughts that come up? Maybe we should address Charlotte's question, but I don't see her here. Oh, there she is. So Charlotte was asking, what kind of thing does SAC want, right? What SAC wants is something that's simple. And what's really frustrating is when people are convertible note here, this safe there, this other safe there, and this great big pile of rat's nest stuff. So we would like rounds that are clearly defined rounds where the rules are simplistic, right? And so this series safe um, eliminates a whole bunch of questions. My preference would be that you could get to a priced round. My personal preference is that we could get to a price round, but my goal is to let Chris negotiate the deal. So I should hand this off to Chris and let Chris think a little bit about the question of what kind of deal would you like for the winner of SAC 29 to have placed in front of you?
Well, I guess before Chris jumps in, what I would say, John,
Mm,
as far as the preference between a safe or Series safe, let's just take Series safe preferred stock and a priced round is that this is non-dilutable equity you're getting before the next round, right? Versus if you invested $1 million at a $10 million post-money valuation in stock, as more money is raised, you get diluted
Loaded.
with each additional dollar in that same round
Yep.
versus with this security, you're still guaranteed, I know I'm going to have 10%. I don't care how much they raise, I'm still going to have 10%. So there's a
Right.
big advantage in something like this over a price round.
At the very beginning, you are exactly correct. Yes. Chris, what is it that you would like to have presented to you by a company? Would you prefer that they say, why don't you tell me the terms you want? Would you prefer they gave you a series safe? Would you prefer that they gave you a convertible note? Just what kind of negotiation, where would you like to start with a SAC company that had passed the finals as being investable?
So just as a clarification, I mean, so the series safe would act just like a safe,
With
but
with,
it
with additional benefits. Yeah.
with the benefit of the, that you're starting the clock running on the QSBS.
Yeah, with clarity, I wouldn't say that safes don't start the clock, but here you have clarity that it does.
Right. Okay. So I think ideally we'd want a series safe. Ideally, you'd want it post money valuation with some sort of discount and most favored nations clauses that, if future investors or rounds provide them with more additional benefits that were not sort of closed out of those. That's kind of the most favored nation benefit. And then I think um, you know, I think those are the main points. I think the series safe actually provides that clock running, and like you're saying, it's the super upside that, if one of these startups actually becomes that 100-time winner, you're actually getting that huge benefit, that tax benefit. And, I think you can't get that from a convertible. You can't get that from the other stuff. That's a huge upside that we're getting and benefit, and it's just investor friendly. And the company's not really giving anything up for that. So I think that's kind of where I would start from.
Beautiful.
Yeah, I
Thank
think
you.
I think that's a reasonable thing. So um we do an investment and we give a 20% discount. And so you run for a year and then you raise your next round and then we get 20% on whatever that price is over there. But um, you actually functionally made a 10x or a 20x improvement in your valuation because you were very sloppy at the beginning and you tightened up. And that 20% discount seems really small compared to the actual quality of your company that you changed. And so I've always thought that this convertible note with the 20% discount really was founder friendly, not investor friendly, in the sense that if you did your job right as a founder, the underlying value gets captured by the founders more than it gets captured by the investors that came in as in the first round. So the series safe seems to be a nice place to keep everything in place. You make some progress when you convert at a price over there, all of the stock all goes into things at the cap. Now the cap is the thing that's creating the value for us because we're buying more shares because your growth in valuation that you paid at the end for the second round is higher than what we're get converting at, which is then gives us a benefit for the great growth that you've done.
That's
So
great. And I really appreciate it. So, one, I think I know the answer, but essentially in this scenario, so we go through that, what have you. Then we've got, let's say, just double valuation cap because of traction, etc. And then let's say we go into like a VC round, which gets us then close to 2 million, 5, 10, whatever. The original investors in this safe, like SAC, for example, they still benefit based on that valuation. Is that generally right?
Yeah, absolutely.
Awesome. Thank you.
So I want to ask Amit the question. I have you labeled it Series Safe, and that strikes me as being very similar to Series Seed. And so if we did a sort of compare and contrast between the old Series Seed stuff, which basically has a very, very simplified Series A priced round versus Series Safe, what are your comments on that difference?
Well, I would say that these are simpler. And in those documents, since it's a priced round, you still need to do due diligence on the cap table, right? Because if the cap table is wrong and there's more shares outstanding than we think, and the price we list is too high and it should have been lower, we're not getting the percentage we were expecting to get. And there's just a lot more documentation, even on the series seed versus this is very simple. It's just a total of, I think, 7 pages of documents. Uh,
Right.
and
And
again, you're just guaranteed that certain percentage. So there's less thought that has to go into it, as far as the cap table in particular.
and so the more complication translates to more time, which translates to more expensive round.
That's right.
And
And the charter document is much longer in those typically because there's just a
it's
lot more to deal with. This
like
is just
20
very
minutes
simple.
or 20 pages the
Right.
last time I
Exactly.
looked. Yeah, right.
So it's still going to be much cheaper, slightly more than issuing a safe, but only the first time because you're just filing the charter amendment, and then after that, it's the same as issuing any safes.
Okay. So how is this being received? How many people
So
have
I've only
done
done a
one?
few of these so far, and so far the investors really love them. But I would say Carta doesn't have anything baked in to handle this, and so until I get Carta to sign up to it, the Carta won't be able to handle it, frankly.
Well,
But the way,
Carta
so the way, so
has
the way to
stopped
handle,
doing SPVs for angel groups, so we can't get the first rounds done by Carta anymore.
but what you can do in Carta is you can adjust the conversion rate of the stock
Mm.
and just calculate it so it's based on the investment amount divided by the the cap table, the fully diluted cap table, and then that's how you would artificially fix it in Carta or in
Uh-uh.
any cap table.
All right. So there are entities that do cap table management besides Carta. Are there others that are in the conversation?
Not so far. The only one I'm talking to is Carta because they're the leader. But
They're
yeah.
they're they're the current ones that do all of that.
Yeah. But
So I
JP
did.
Morgan's really getting aggressive. They're giving their cap table software for free. They're
Yep.
doing all kinds of free bank accounts, all that stuff for founders. So they are
Yep.
being very aggressive trying to eat Carter's lunch.
Right. And there's a company out of UK called Quorum, Quoroom, that is also working on coming into the US that's targeting the same market. So we'll see where they come in as well. Other people have any questions? Brett, how would the Alliance of Angels think about this?
It's something that I think they would consider. They'd probably want to explore it a little deeper, but I know there's a lot of members that are anti-safe, but at the same time, it would really be good to have the clarification of starting that clock.
Yeah. Perhaps you can arrange with Amit to do a workshop for internal to AOA.
We can discuss that. Yes.
Yeah,
Yeah, that'd
happy
be
to.
great. Chris?
Amit, just a point of clarification. Have these safes been, the series safes, like how have they been approved or have they been challenged or any of that?
No, I
Uh,
mean it's too new for anything to be challenged. So no. No, it's not been challenged. I mean, I'm not sure what the challenge would be, but there's nothing been challenged yet. But it is fairly new, you know.
So new as of when?
Oh, only like a few months ago.
Okay. And we're lucky to know about you because of Let's Play Money that we used on Seattle Angel Conference 28, and they're apparently paying attention to you. So that's working out pretty well in your direction. Um, are there things that we should be doing to share the story about these things?
Well, I mean, I'd love it if you shared it on LinkedIn or whatever you can to help build some consensus
Yeah.
around this.
So my ask to all of our participants here today is that you post something. If you learn something today about anything to do with founders and safes and stock and so forth, post an article about it and reference the link that we're going to put on YouTube. So this recording will end up on YouTube, and you can work from there to share it. Anything you want to ask us, Amit? You have founders, you have investors.
Yeah, I guess from the investor perspective, what is it that you invest in? What types of business do you invest in? What's your typical check size? And,
Yeah. So
and what are you looking at when you invest?
let me explain the Seattle Angel Conference process, and then let's let Brett talk about what AOA does. And then we have a couple of other investors here talk about their contexts. So Seattle Angel Conference is a training program for angels that is sort of the chemistry lab class version of angel training. It's a 3 month long program. So some of the folks here, like Kevin, are investing in the program, and they will invest their $5,000. We will create a fund near $200,000, and we will sort through. We have 71 in the queue right now, 71 companies, and out of that, we'll take them from 70 down to 6 finalists, do due diligence on them, and argue about where that fund ends up getting invested. So we do this 4 times a year, twice in the US, twice in the European context, and we write essentially one check per cycle. And then if the companies are effective and they build a following that maybe is not the majority of the people in the room, but enough that a second check can be written, then there's a second and third check that get written as sidecars. So we're
Okay, so you
currently,
have a fund that you raise every
we
year.
create a new SPV every
Oh, for
cycle.
each oh, for each
And
investment or each cycle?
every single investment gets its own SPV because, for instance, Chris is the person who has responsibility for the investment for the duration. So at the beginning, we're saying to Kevin, Kevin, is this a good company? Answer that question. And then we say to Chris, Chris, is this a good deal? And answer that question. So we split up the angel investment process into 2 cycles. So Chris has gone through several times, and now he's being the leader. Now he's getting to practice being the angel investor leader of the program by structuring the deal, gathering the investors, gathering the companies, managing the compliance of the deal is his task, which Kevin is not doing any of that. All that Kevin is doing is coming through the program and trying to decide, is this a good company or not?
Oh,
And so
okay.
we train lead angel investors by running an investment that needs a lead. And in this case, David and Chris are the lead. Now, that's entirely different than what the network Alliance of Angels does, which is also entirely different than what the Alliance of Angels Fund does. So, Brett, would you like to talk about that?
Sure, I can do that. Yes, the Alliance of Angels is a group of about 180 to 200 individual people that meet pretty much monthly and review a number of companies. And of those companies, then everybody indicates whether they are interested in one or more of the companies, participates in joint due diligence on them. And during the due diligence process, individuals will determine whether they're going to invest in the companies or not. And a lot of times, generally, the companies we see come through Alliance of Angels, the minimum check size is usually 25,000. We did have one yesterday that said they'd take a $10,000 check, but most of the time it's 25K. Sometimes it's a little higher. And so each one of those 180 members individually determines whether they're going to invest in any particular company that's presented. We then, as John mentioned, have a angel fund that we provide as a service to our members that they can invest in the fund itself, and the fund collectively invests, kind of like what SAC does. So everybody that's a member of the fund is getting a vote in whether the fund itself invests in any of the particular companies that are nominated to the fund. And if so chosen and selected and approved, those companies will usually get a minimum $100,000 check, sometimes up to 150K.
Okay, that's great. The fund is nice because it provides automatic diversification to those
Correct.
people. Because, what's the, I think for venture investments, you have to invest in 12 to 14 investments
Hmm.
statistically to work out well. But with
And
angel,
that's
you're talking 30 probably.
Yeah,
So,
yeah,
we'd say
with
20
our
to 30.
fund. Yeah, with our fund, each it's an annual fund, so we regenerate it each year, and each annual fund will invest in around 15 companies, plus or minus, depending on the size of the fund.
And it's a multi-investment fund,
Yes.
as opposed to ours are one fund, one SPV per investment. And if we do two or three investments, that's two or three SPVs. So we have extraordinary overhead compared to
yeah.
Brett's process, which makes me a cranky old guy around SPVs at the moment.
Yeah, we form an independent LLC for each annual fund, but each fund then will invest in the 12 to 15 companies, and so we don't have a separate SPV for each one of those.
Fair enough. Any other investors want to talk about your kind of investing and your structure of your checks? No, no one else is excited to share. All right. We do have someone calling down all of the 64 funding groups in the Northwest to ask those kinds of questions. So, and we do have on our Meet the Funders a report about, the 10 that are most frequent in the circle around us. So I haven't yet posted that, but I will soon post that on the YouTube channel. So please take a look at the YouTube channel for our Meet the Funders thing when it goes up. Um, Anything else you'd like to know? Oh, Amit, if you care about Seattle, Seattle Tech Week is the last week in July. You might choose to come that week. And if you wanted to do a workshop in person in Seattle Tech Week, we are building a Seattle Tech Week series for early pre-seed stuff.
Okay. No, that
And
sounds great. I mean, if I don't show up, it doesn't mean I don't care.
well, if you want to do the workshop, then we need to propose it
Yes.
before the beginning of April. And so think about it and send me a note if you
Yeah.
want to do something. Our goal is to have a series of workshops about pre-seed and seed funding every day somewhere in Seattle that week.
Okay. No, that'd be great.
Cool. Yes, Mac.
So appreciate the information during this presentation. One of the questions that came to my mind was, I'm working with Charlotte with Reearthable. She has it as an LLC right now, and at some point, probably likely before raising funds, convert it to a corporation. Uh, but one of the questions I have is, I heard Amit mention Delaware a couple times and just wanted to know, is there anything special about the Series Safe in Delaware, since Delaware has kind of fallen out of favor with incorporation over the last, I don't know, 8 years or so?
Well, so this would work fine in any jurisdiction.
Okay.
Delaware is still the dominant jurisdiction. I agree that, you've got Elon Musk and there's these different cases, and then there was some law that changed the Delaware, the Delaware statute was amended to make it a little more clear and favorable to the founders to try to stem the flow of companies away from Delaware. But Delaware is still the dominant jurisdiction because every corporate lawyer knows Delaware. Not every corporate lawyer knows Nevada, definitely not Texas. And so, but those are trying to catch up. Like it used to be a big benefit that Delaware had its own Chancery Corp chancery court that only does corporate law cases, and so there's very sophisticated judges there. And now some of the other jurisdictions are copying that, and the code is a little bit more favorable to the founders in some of those jurisdictions. But ultimately, the fact that every corporate lawyer knows Delaware corporate law has been litigated for so many years, and the statute is a very robust statute. So the most predictability still probably is in Delaware as far as the outcome. And so that's why it continues to be the leader, but that doesn't mean that there aren't different reasons why you might want to choose Texas, Nevada, probably not California, but
Oh,
some of the other jurisdictions.
And Wyoming.
Oh yeah, yeah, Wyoming.
Wyoming.
Wyoming was the first one to create an LLC in the first place.
They're also the first one to tie a DAO to an LLC. So there's
Mm.
some creativity there that you're not getting out of Delaware. Are there other thoughts or questions that people want to make sure you take the opportunity to do this? So, Amit, you want to put your LinkedIn into the chat and let people connect with you that way?
Oh yes.
And Charlotte, go ahead.
Yeah, so I just completed the WTIA program, and that was really a good groundwork of getting me back into this community. And I was kind of the anomaly, being kind of a material base, pretty much AI for what have you. But I'm just curious if you have any input on kind of the trends, John and the group and Brent, Chris, what you guys are seeing in terms of from the angel perspective, where you think those investments are landing. We're so AI'd out, but any kind of trends that you could point to?
Well, I would argue that you don't actually know what the trends are because it's way underreported. And the thing that you need to know about angel investing is that it's very idiosyncratic. So it depends on how the person is feeling today and how it connected to them in the moment, right? And so the further up the scale you go, the more regular structure that you might see to investments where you have funds with the thesis where they're being organized about their investment. But when you're at the pre-seed level, it's a function of an individual investor having faith that the investment is going to do something that's interesting to them at some level. Uh, a lot of times in Seattle, the angel investors that are software people are extraordinarily hard on their evaluation of software companies and in and in inordinately delicate with things that are not software. And so they might choose a non-software thing that they shouldn't have because um, they beat up the software company because they know everything about software, right? So we've seen the software engineer invest in the lettuce company because it was cute and shiny, not because they understood what growing lettuce meant. And so idiosyncratic, right? So I don't think that that's reasonable to try to look for trends among angels. What I think you need to do is build relationships and find out where the relationships are, because the number one thing is the relationship between the team and the investor. Amit,
Thank you.
you have any commentary on that?
Yeah, no, I agree. I think that, but I would recommend people invest in things that they know, but maybe be cautious about being overly aggressive, so you price yourself out of investments you really know and understand and you could do well in.
Yeah.
Thank
Timu,
you.
Timu, go ahead.
Oh, thanks, John. Hey, real quick question. Since this series Safe is a new um, vehicle, if you will, uh, how I know you said it's been months, so I'm looking at it from a founder perspective. I don't think that there's anything that I would lose per se, as as far as anything that would affect me materially otherwise, other than it's a new vehicle. So how would I convince that this is? I'm thinking that maybe a positive for me, because if I can say I have something, I have more protections for you, angel investor, I'm willing to do this because at the end of the day, if I believe in myself and I believe in my product, believe in my business, I'm going to be like, I'm whatever the outcome's going to be positive. So I'm willing to give you more protections using this vehicle. But how does the market interpret that since it's new? So that's more friction. It's more system two thinking. There would be like, what is this new thing? They have to go in. So it's a harder conversation perhaps to have. What kind of assistance could you provide on that?
So,
Well,
so two things. The first thing is, as a founder, you have to know your numbers. And when
Yeah.
you, as a founder, come and you present a generic answer to the safe, I'm using a safe, and then you don't really understand the consequence of the safe, that's the equivalent of not knowing your numbers. So if you have this new thing and you understand it and you can talk to the benefits of the QSBS, you're essentially knowing your numbers in a meaningful way. Um,
Okay.
if the second thing is if your lawyer can't process what Series Safe is, or their lawyer can't process where it is, like if there's blowback from the lawyer, then you have a lawyer that is generic, which is not to your benefit. And when things
Fair.
get going, you'll be in trouble because they will have given you the generic answer when in fact
Yeah.
they didn't truly process the answer. And so you want a lawyer that's paying attention. And if the QS or the series safe will give you a way to evaluate your lawyer. And if the process with your lawyer gets confounded, it's time for you to think hard about your lawyer. Amit.
Thank you.
yeah. Yeah, I think that, you can say it very simply that you're getting the same economics as a safe, but you're getting clarity on the tax benefit, the QSBS tax benefit is probably the simplest way I would put it.
Yep.
Appreciate it.
Anything
Sorry,
else?
I moved spots here. So
Mhm.
Yep. Okay. Well, any one last pending question? No. All right. So we are shifting our attention now. Next Tuesday, we will do um, I see Rick just posted. It seems that the investors have a liquidation preference immediately, but the percentage is unclear rather than after the conversion event. You want to address that? I mean,
I guess, can you repeat the question? I didn't quite understand it.
Rick says it seems that the investors also have a liquidation preference immediately, but that the percentage is unclear rather than after a conversion event.
Yeah, so before whether it's a safe or series safe preferred stock, if I invest $1 million at a $10 million post-money valuation, if the company were to be sold today, I'm going to get the greater of my investment or 10% of the proceeds effectively. And that's true if it's a safe or series safe preferred.
And it doesn't, the preference doesn't happen later. It happened, the
That preference would
acquisition of
happen
that is
then.
at the beginning. Yeah.
Yeah. So if it's not converted because there's no round that has occurred to raise capital, but the company gets sold ahead of time, then I'm going to get the greater of, if I invested $1 million at a $10 million post-money valuation, I'm going to get the greater of $1 million or 10% of the proceeds of that deal.
Great. Great. So thank you so very much, Amit. For the Seattle Angel Conference, we're switching our attention to running the program. So we'll be doing fewer workshops every week. So a bunch of the people who have been in our workshops will be busy actually doing an investment process that'll take 3 months. Do save on May 20th as the demo day so that you can come and see the outcomes of our process. And if you have something in Seattle that you think Amit needs to know about, please connect with him on LinkedIn and drop him a note about the things that are happening here that would be interesting to him. Thanks everyone for coming. We look forward to seeing you at our future workshops.
Thank you, everybody, for having me. It was a pleasure. Cheers.
Thanks.
Thank you.
Thanks. Thank you very much.